In 1.6D, we're going to follow up from 1.6B, where we had the following four assets of the business that we're going to last for the next 3 years: the computer, the printer, the stapler, and the ruler. So we listed them all as non-current assets there in the balance sheet. This question is actually asking, can we treat any of these items as expenses for 2015 instead of assets? And the answer technically would be no. They're all going to actually be used for the next 3 years, so therefore they're going to provide future economic benefits. They're going to have to be assets. I guess what we can say is that it's a bit impractical to keep the stapler and the ruler on the balance sheet for 3 years when they're at such small values. So what we might be better off doing is actually transferring those two items through to the income statement for 2015, getting rid of the stapler and the ruler, and therefore changing the amount of non-current assets we have in the balance sheet and increasing the amount of expenses that we have. So our two choices are as follows. We can treat all four items as assets, so list them all as non-current assets like so, and therefore we'd have no expenses. Or secondly, we can treat the stapler and the ruler as expenses by taking them out of the balance sheet and therefore moving them to the income statement. So you can see there's going to be a $14 difference between the non-current assets section. It'll be a little bit lower, and with expenses you'll have $14 of expenses that aren't there in the balance and the income statement at the top. So should we do this or not? My answer is going to be yes. We should treat the stapler and the ruler as expenses for 2015 instead of assets. It seems a little bit ridiculous to keep a $10 stapler and a $4 ruler in the balance sheet, considering the balance sheet's going to have a lot of items, and these small figures like this aren't going to make too much difference to the overall running of the business. So to back up my opinion, I'm going to identify a qualitative characteristic or accounting principle, in this case relevance. I'm going to define it. Relevance states that all information which influences the decision making of the business should be included. In particular, all items that are material must be included. Lastly, I'm going to relate it to this question and say the stapler and ruler can be written off as expenses because even though they will provide economic benefits into the future, you can not include them as assets because their amounts are not material to decision making in 2016 and 17. Whether they're in the balance sheet or the income statement is really irrelevant in terms of the overall decision making of the business. We might as well write them off as expenses now so we don't have to carry such small amounts in the balance sheets. The overall thing being that these two items aren't material to the day-to-day decision making of the business.